in many of the conversations I'm having here with experts, this increased bifurcation of society, keeps coming up, and it's a concern to me, but it's a concern to many. And I would love to hear more of your thoughts on that.
Well, I would just say after the 2008 global financial meltdown, you really spawned a lot of people feeling cynical that the game was rigged against them. You had a meeting of the minds that brought in the Occupy Wall Street movement with the Tea Party movement, and just this idea that government is supposed to carry out basic functions that I think include, if you constitutionally look at it, include the right to sound money. It's in the Constitution, Article 1, Section 8, in the same sentence as Congress is empowered to define official standards of weights and measures, because money was always meant to be a standard, to be an official measure of value. And that implies an unvarying measure. And certainly Thomas Jefferson thought that he wanted the dollar to be a universal money unit of account. And that's why he decided in his notes on the establishment of the money unit for the United States, it's about a 17-page essay. You can see it at the Library of Congress. He said that the money really has to work for the average person. It should not work for the financiers. It should be familiar. It should facilitate daily transactions. It should establish a common currency across the 13 former individual colonies. And he really thought that it was wrapped up in our national culture. So I think that almost implies a moral obligation of the US government, since it does impose legal tender laws, to provide money that's dependable. I think it's a form of chiseling, even for the Fed to deliberately target 2% inflation. I mean, after 10 years, that's a 2% devaluation, which I would call an expropriation. What if you had just saved your money all that time? And I remember once Ben Bernanke, when he was Fed chair, someone posed that to him, and they said, well, what if you just want to put your money under the mattress? You don't feel sophisticated enough to invest it. And he treated that as, well, if you're that provincial, almost you deserve to lose money every year. And I think that's a wrong attitude. I believe that people's savings really underscore, as a cultural value, and certainly one that's a virtue in capitalism, which is saying, I'm willing to save. I'm willing to save now and use my savings as seed money to finance a greater harvest in the future. And that's how you improve standards of living for all of society. And that's real. And because if it's used productively to actually, as I say, I keep going back to, I love people who make things or people who provide services. I like the emphasis on manufacturing and keeping it real. There's just been too much getting the brightest minds to be the quants who outsmart with algorithms and the option pricing model, what's going on in credit derivatives and currencies, and just the foreign exchange market is just a speculator's paradise. And I blame governments for not having coherent international monetary arrangements so that you would have a level monetary playing field, which is the only reasonable foundation for free trade. If you can cheat by depreciating your currency, it's so unfair to people who are trying to create something the best quality at the lowest price. That's the essence of how free markets work. But if you then change the terms of trade by underpricing them because you've manipulated your currency, it completely violates all of the logic of free trade. So I really think we have to think through these things and really seek a stable foundation for international trade. And I think it can start at home in helping people to believe that they can trust their own money. And when the Fed's mandate is stable prices, the original legislation defined that as 0% inflation.
Judy, I think that may have been the most meaningful 3 minutes I've ever recorded. in my career here. So thank you.
Thank you.
That deafening roar you're hearing is, I believe, the viewers of this conference giving you a standing ovation from their laptops.
That's nice.
That really was absolutely tremendous. Wow.
China has bought much more gold than the official transactions tell you. They're not reporting all of their gold buying, and right now this weekend, in fact, at the SCO meeting, the Shanghai Group, we had basically unification, which is incredible and very dangerous for the U.S. But India and China and Russia. Now they're the best friends after this meeting this weekend, and we always try to prevent them from putting an alliance together. What would happen right now, for example, if these three nations having 36% of the world's population say, we don't need to trade with the US. If they want to raise our tariffs to 25 or 50%, we don't have to trade with them at all.
At the 2025 SCO summit, India's Prime Minister Modi met with Xi Jinping and Vladimir Putin, signaling warmer relations. China, Russia, and India strengthened ties in response to US tariffs and Western pressure, presenting the SCO as a rising economic bloc independent of Western institutions. Together, these nations represent 36% of the world's population, giving their partnership significant economic weight. With China secretly stockpiling gold and reducing reliance on the dollar, this alliance highlights a global power shift and exposes U.S. vulnerabilities in trade and finance. A 49-year veteran market expert, Bert Doman, recalls that since 2007, market manipulation has become much easier due to the removal of the uptick rule, which had been in place since 1933 to prevent short-selling abuse. Its removal opened the door for high-frequency and algorithmic traders to heavily manipulate markets. Many believe the SEC protects investors, but in reality it often protects insiders who benefit from such moves. This makes rallies risky, as they can be engineered, and safer bets like gold and silver have offered better returns during uncertain times. Looking at history, gold peaked at $800 in 1980 before entering a 20-year bear market, just as cycle studies had predicted, Bert Doman says. The bottom came exactly in 2000, aligning perfectly with long-term trends. Analysts had already forecasted back in 1980 that after this cycle, gold would begin a powerful secular bull market. Unlike shorter cyclical swings, a secular trend is long-term, and the current rise in gold is part of that ongoing secular bull phase. As we play snippets from the video, kindly click the like button, subscribe to our channel, and enable the notification bell to receive fast alerts whenever we post a new video. I appreciate your support. Have fun watching the video.
No, with the manipulation today, it's easy to be wrong. For 48 years, we basically called most market tops within a day or two. Okay, and that is using advanced technical analysis. It's become tougher since 2007. In 2007, they made it possible for the high-frequency trading and the algo traders to sell short without waiting for an uptick. We had the uptick rule in place since 1933 with Joe Kennedy, who was a big manipulator in the 1929 crash. He and his guys crashed the market in 1929. And then they made him head of the SEC. And he said, well, if we would have had an uptick rule in place, we could not have manipulated the market downward. That means that if you put an order in to sell short, the order before that had to be on an uptick, a higher price, even if it's only at 1/8. And so that uptick rule was in place in 1933. And in 2007, they did away with it quietly. And we read it and said, oh, something is up. There's going to be a crash next year. And they want to make a big big money out of that. And of course, we had the crash in 2008. So this was all manipulated. People have no idea. They think the SEC is there to protect them. No, the SEC is there to protect their friends. So a lot of money is being made with these manipulations, and the up move in early April in the stock market, we said that it's going to be a bear market rally, but we'll probably have a couple of the indices making new highs by a small amount. But we don't want to play this. This is too dangerous because it doesn't necessarily have to happen that they will go as far as a few indices making new highs. So we sat that one out. Yes, we could have made a lot of money in that rally, but we had gold and silver, and they made a lot of money for us. And then you asked about gold before. In 1980, gold had hit $800 an ounce. Okay, so we were along for the whole ride from 1977 onward. 77 is when I started my business, and so we were along for the ride. But then we got a sell signal on our indicators. We said, "Okay, time to sell. Take profits. It's been fun." And then we did a cycle study on gold going back 400 years. So that was about 200 years in the US and 200 years we had to go to the data from Britain. And so we said, okay, this is going to be a 20-year bear market in gold. People thought that was crazy because everybody was still waiting for $3,000 gold at that time. But it happened. When was the bottom of that bear market? Year 2000, exactly 20 years after 1980. And it was amazing to us even because usually cycles, they move a little bit to the left or to the right, they're off by a few years and so on. But the bottom was in the year 2000. And, people want to know what the second part of the cycle study said is how far the next up move would be. So far, it's correct. Okay. Mm-hmm. So we said in 1980 how high this market would rise, the current bull market. It's a secular bull market. You always have to differentiate between a cyclical bull and bear market and a secular. Secular is very long term. Yeah.
Bert Doman point out that in the first phase of a market crash, investors facing margin calls sell whatever they can, including gold and silver, causing their prices to drop temporarily. But once that urgent selling is over, gold and silver rebound strongly as people seek safety while central banks print more money, eroding its value. That's when these metals shine as the only true protection of wealth. At the same time, India's warming ties with China and Russia at the SCO summit mark a shift toward a multipolar world, as the three nations, representing over a third of the global population, find common ground against Western dominance. Analysts warn that U.S. tariffs, especially on India, may be backfiring by driving these countries closer together. If they retaliate with tariffs or reduce trade, U.S. supply chains and retail sectors could face major disruptions, underscoring America's vulnerability in this shifting global balance. Now, let's recall the interview.
See, in the first part of a bear market, when the markets just tumble, and everybody has to scramble because they're getting margin calls. So they sell what they can't sell. And gold and silver, of course, does have bids, and then they will sell that too. And in the first phase of a decline like that, gold and silver will get declined because it's being used as a source of cash to meet margin calls. But then comes the second phase, and that is when all that is urgent selling is out of the way, and that is when you really want to buy gold and silver. That second phase, because then everybody goes to safety. And gold and silver is considered the only safe thing, because the central banks then will step on the accelerator, manufacture as much money as they can, as they did in the year 2020, 2021. And that means that your money is worth less. The purchasing power of your money declines, and the only safety for that is gold, silver. Mm-hmm. They will go up. So gold and silver, gold has been an island of safety for thousands of years. It's not going to change. I think they know what's going to happen, what is inevitable. China has bought much more gold than the official transactions tell you. They're not reporting out of their gold buying, and right now this weekend, in fact, at the SCO meeting, the Shanghai group, we had basically unification, which is incredible and very dangerous for the U.S. But India and China and Russia, now they're the best friends after this meeting this weekend. And we always try to prevent them from putting an alliance together. Now they are the best friends. Now this is together. These three countries have 36% of the world's population. That is a big amount. 36%. Do you know what the U.S. is? U.S. is 4.1% of the world's population, and this is where Mr. Trump is so wrong. He thinks that everybody needs the U.S. consumer. Okay, he's wrong. What would happen right now, for example, if these three nations having 36% of the world's population say, we don't need to trade with the U.S. If they want to raise our tariffs to 25 or 50%, we don't have to trade with them at all. We don't need their consumers. We've got enough consumers outside of the United States. And in fact, we don't even have to do anything more. We don't even have to supply them with our stuff. We're just not going to even sell to the United States. Can you imagine if these three nations suddenly decide not to sell their stuff to the U.S.? The shelves at Costco and Walmart, etc., Target, they're going to be bare. Because you take a look at all the merchandise you see on those shelves, turn them upside down and see where they're made. They're made in these three countries, most of them. So I think we are much more vulnerable to them boycotting the U.S. than us boycotting them.
Both Bert Dohman's market insights and the geopolitical shifts seen at the 2025 SCO summit point to a world entering a new phase of financial and strategic realignment. As gold and silver continue to prove their long-term resilience, the strengthening alliance between China, Russia, and India adds another layer of pressure on U.S. dominance. These converging trends suggest that investors and policymakers alike must prepare for an era of heightened uncertainty and rapid change. Could the growing China, Russia, India alliance accelerate the decline of U.S. financial influence? Will gold and silver remain the most reliable safe havens as global markets face manipulation and geopolitical upheaval? If you like the analysis, then share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.
I think a jump probably I expect conservatively at least 10% more by the end of the year, which would put us at 44, and perhaps 20% more, which would put us at 48. Time will tell, maybe this is going to sell off really quickly and we only get, couple days above 40. I doubt it. I think the momentum is in our favor. It's after, I'm laughing, it's after Labor Day. Historically, we see strength into the final quarter of the year. We're not there yet, but we're getting there. So and the miners, and I want to talk about that quite a bit, but the miners are something that really are assurance that we're in a true bull trend. I want confirmation. I want not only the miners to do well, I want them to do better than the metals. I want to see that 2 or 3x eventually, where they outperform by a factor of, 3x, for example. So if gold moves up 10%, top tier miners are moving up 30%.
Silver is up 42% this year, outpacing gold and marking its strongest 5-year rally, fueled by industrial demand from solar, EVs, and electronics. HSBC raised its outlook, citing a growing supply deficit of 206 ounces in 2025. Analysts agree silver remains undervalued despite big gains, with momentum pointing to $44 to $48 by year-end. Mining stocks, especially juniors, are already outperforming, offering leveraged upside as investors rotate into the sector. David Morgan, widely known as the Silver Guru, is a seasoned precious metals analyst, author, and founder of the Morgan Report. He points out that silver's momentum is building thanks to institutional buying, industrial demand, and algorithm-driven trading that continues to push prices higher. Despite heavy short positions, the trend has turned positive, with momentum indicators signaling strength. Gold has already broken out, while silver, being a smaller market, tends to move more sharply once momentum takes hold. Historically, miners often led metals higher, but this cycle has been different. Metals surged first while miners lagged. Now, strong earnings and value recognition are finally fueling a rally in gold stocks. Silver stocks remain trickier since most companies are not pure silver plays, often producing other metals alongside it. Still, silver miners can command higher premiums in bull markets because of silver's volatility and popularity at the top. David recommends that traditional valuation metrics like PE aren't the best for miners, as free cash flow and balance sheet strength matter more. According to the Morgan Report, well-positioned mining equities, starting with blue-chip producers and selectively adding speculative plays, offer some of the best leverage in the resource sector, especially as demand for metals like copper, lithium, and rare earths accelerates. As we begin the video, don't forget to hit the bell button and subscribe so you don't miss any updates. Please leave a comment below and give us a thumbs up if you found the article interesting. We appreciate your feedback.
As I've said before, and it sounds trite, but it is true, and that is there's more buying pressure than selling pressure. And there's been a rather large short position in the silver market, as there usually is, but we all know that the market is set as a derivative. The price in the futures market, which dictates the spot price and what coin dealers sell their metal for, and et cetera, is determined primarily by algorithms. And so at certain levels, certain things happen. And I have to defer to Michael Oliver, and Michael does momentum, and momentum is very important. Being an engineer, momentum is defined as mass times velocity. So like the whole idea of changing trend with a ship in the ocean, if you have a huge ocean liner, that's a lot of mass. So it's hard to change the direction of it. And the way you do that is slowly. That's how these major trends can change at times. The point being is that the momentum is in our favor. The algorithms are saying buy, and the institutions are buying it mostly for industrial purposes. Yet we do see entities such as Russia that's allocating silver. And you're also seeing on the gold side where China says that their insurance industry can allocate up to 1% in gold. So there's a lot more momentum in a lot of ways in both these markets. And silver, being a smaller market, gets a larger move than gold once the momentum starts. I've been in this market more than 40 years, and I'm still learning. And historically, the miners will usually lead the metal. And I say usually because, and that's a tip-off for somebody that's, studied these markets. These gold stocks are moving, but nothing's happened in gold. We're probably going to see a rally here. Well, that did not take place this time. The opposite occurred. We saw the metals, especially gold, take off, and the miners were lagging. And I think it has to do with a lot of things. But one of them is that the market is much more sophisticated, a lot more computer trading, a lot of algorithms out there that do the trading. And the other thing is the value investors still look at one thing primarily, and that's earnings. Now, the earnings in the gold stocks have been phenomenal, but it hasn't equated into the price of those companies, because many of these companies are trading as if gold is at $2,000 the ounce when it's been at, roughly 33 to 3,400 for 4 months in a row consolidating. And that information is now going where? Into the algorithm, into a trading desk, into a hedge fund manager, into the general public, into a whatever, pension fund. And whatever it goes, that knowledge is saying, hey, I'm a value investor. This is a real value play. This stock has got to eventually catch up to the earnings that it is providing that we know we have. And so that is what I think fueled the rally in the gold mining industry. Silver lagging, but silver actually is a smaller market, as we know. There are very few pure silver plays, if any. There's really one silver stock I can think of that's more or less pure silver play. The rest are silver plays, but they have, lead or zinc or copper or gold or something, combination thereof. They're still silver stocks, but they get a bigger margin than gold. For example, at the top of the market previously, we saw a PE of a top tier gold company sell at like 30 PE, but an equivalent silver company would sell at a 50 PE. Well, why? Well, silver is more volatile, and I guess it's more loved at the top of a market than gold is.
I'm not finding it in the comps table. I was curious where we're at in terms of valuations for the major miners, but also some of the smaller producers. Like, where do you think we're at right now? Do you have an overview?
I don't. I know we're below that, I think, in some instances. I do want to make a caveat here because a PE is not a very good metric for a mining company. I mean, there's a couple big books back there that are hard slogs, and valuing a mining company is much more about free cash flow than it is a PE. PE is useful at the top of the market to get an exit strategy. Can be used, but it really isn't like a retail store selling, women's clothing or, grocery store, what have you. It's not a good metric for a mining company, but people use it. There's nothing against it, but it really isn't the best metric. So I just want to get that into the record because, that's what we do primarily at the Morgan Report is analyze mining companies, not just gold and silver, but, lithium, cobalt, the rare earth elements, the battery metals, you name it, copper. I'm becoming much more bullish on copper than I was, let's say, 6 months ago. So there's a lot happening in the resource sector. And one of the best leveraged plays you can do with lower risk, not no risk, is in the mining equities. And if you start with blue chips and work your way down into a speculative section where you basically make the correct bets, meaning how much money you allocate to each tier, you can do quite well and have a balanced risk to reward profile.
David mentions that in Elliott wave theory, the third wave is usually the strongest and most dynamic, marked by the sharpest price gains in the shortest time with heavy trading volume. This stage reflects a major shift in psychology, moving from disbelief to broad recognition as more participants enter the market. Currently, silver seems to be in the early part of this leg, with institutional and industrial demand driving momentum while retail investors remain hesitant, especially those who only recently broke even. Asian markets are also playing a larger role than before, though retail silver buying there still lags behind gold. Looking ahead, this leg could bring the most powerful price appreciation yet, potentially lasting several more years. While past rallies, like the false start in 2016, failed to sustain momentum, the current setup appears stronger, supported by gold's breakout well above $2,000 and holding near $3,500. David predicts that the coming days will confirm whether this is a genuine breakout or another fake-out, but the fundamentals and market psychology suggest silver could now be entering its most explosive phase. Let's move into the interview.
That wave 3 up, there's 5 waves in Elliott, is usually the strongest and most dynamic move in the sequence. It's where the leg prices cover the largest distance in the shortest amount of time compared to the other waves. It often has the heaviest trading volume. It tends to be the longest and most powerful wave, though not always. It's driven by a big shift in market psychology, which we just discussed, disbelief from earlier stages, followed by recognition and enthusiasm as more participants jump in. So since I think we're in the beginning of that leg, we're seeing more and more participants jump in, but we still have a fair ways to go, meaning that retail that's given up on silver, maybe not silver stocks, but very few retail investors that bought even in the 30s are buying in at 40. It's like, I've broken even or I'm slightly ahead. Let's see how far it goes. but institutions need it, or industrial users need it. And so that's fueling the market. I think the Asian markets are more involved than they were in the past, although silver is not nearly as bought on a retail level in the Asian markets as gold is. Regardless, we're seeing that momentum change. And I do think that we're going to see, as it says, probably the most dynamic move in price appreciation in this last leg up. And again, where does it go? I'll say probably a couple more years. And just to be sincere, I have said, we got a couple years left, more than once, and probably as long as 5 years ago, and I was wrong. But, whenever you stick your neck out, it can be chopped off. But the facts are backing me up now. There was a false start, I believe, in 2016. I can, talk about that. I don't want to, but there were times when it looked like we were going to break into the next leg up, and it really didn't carry through. This time, it's obvious. Gold is well above the 2000 breakout level. It's $1,300, $1,400, $1,500 above that. Almost not quite a double, but from 2000 to 3,500 is quite a move. And it sustained it, and we're breaking out of that consolidation. Remains to be determined if it's a breakout or fake out. We have a couple more days to watch. But no, it's exciting times.
Silver appears to be entering a decisive stage where strong momentum, institutional demand, and shifting market psychology could fuel its most powerful rally in decades. With gold already sustaining record highs and miners beginning to catch up, silver's smaller market size and volatility suggest sharp moves ahead. Whether this proves to be the beginning of a lasting breakout or another temporary surge, the conditions look stronger than they have in years. Do you think silver can outperform gold in the next phase of this bull market? Will retail investors return in time to catch the biggest gains, or will institutions dominate this rally? We would be glad to hear your opinions, so please leave them in the comments area below. If you found this video useful, please give it a thumbs up and remember to subscribe for future videos. Thank you for joining us on this adventure.
We are at the end of a major monetary era, and this one is so big that it's going to end, sadly, a catastrophe for the world. This is why we went into gold investments for ourselves and for our clients at the beginning of this century, and we never changed our mind, and we're, as you know, only in physical gold and helping people around the world.
The way that Modi, who had been playing a two-step dance with Trump and with Russia and China, has now gone into a quick step right into the hands of Putin and Xi.
But isn't that telling us that, this is the end for the West, the end for the United States? Obviously, the EU will follow also.
What will emerge is that China is going to stand firm on tariff and trade issues.
We are at the end of a major monetary era that will end in global catastrophe, which is why they've stayed invested only in physical gold since the early 2000s. At the recent SCO summit, warmer ties between Modi, Xi, and Putin signaled India's shift toward balancing U.S. pressure, especially after friction over Russian oil tariffs. Analysts warn that U.S. deficits, trade wars, and eroding trust in the dollar could make capital controls increasingly plausible, with scope even warning of a potential U.S. downgrade. While there's little hard evidence of large-scale U.S. capital flight into Switzerland or gold, uncertainty is fueling concern that the dollar-centered monetary order is weakening as a multipolar world emerges. Key risks ahead include potential U.S. regulatory moves on capital flows, further rating downgrades, and rising demand for safe haven assets like gold as geopolitical and financial pressures intensify. The speaker, Egon Von, the founder of Matterhorn Asset Management in Switzerland, in a crosstalk with Simon Hunt, is an independent strategist and consultant, warns that capital controls are coming to the U.S., with the dollar and financial system under attack. There are signs that confidence in the dollar is weakening. Investors are reacting to U.S. trade's tariff policies, rising debt, and political uncertainty, which in turn is leading to discussions about de-dollarization, diversification, and concern about the dollar's future role as the world's reserve currency. Figures like Robert Kiyosaki are warning of a looming central bank crisis. Egon and Simon suggest investing in gold, silver, and even Bitcoin, though often with caveats, as hedges against fiat collapse. Elevated inflation and weak growth plus geopolitical tensions are pushing institutional and private investors towards inflation hedges: gold, silver, real assets. Some analyses point out that usual safe assets, bonds, cash, may offer lower protection in this environment. Egon warns today's risks include banking crises, collapsing currencies, and rising social unrest, especially in the US. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I'm absolutely convinced that we will have capital. There will be capital controls in the US also. Dollar will be under attack. The financial system will be under attack. People want to transfer money out of dollars now are actually doing it now already. And we're seeing it. Americans reports about, especially the big banks in America, looking after wealthy families and individuals, that they're transferring a lot of money into Switzerland and also into gold, of course. There are not many places to flee to, are there?
No.
You got where you are in Uruguay.
Yeah.
Sorry, in Dubai, I mean. Uruguay is another one. From my point of view, I think Dubai is obviously fantastic now, but, it is next to the Strait of Hormuz. It can't be nearer than it is. It's so near. And, there has always throughout history and even throughout my lifetime been major conflicts in the Middle East. And, of course, then Dubai will be exposed also. For quite a while, part of my long-term forecast, I clearly saw at the end of the 90s already, and this is why I decided that we need to protect ourselves. You never know when it's going to happen exactly, and that's why we said, this is going to come. The end of a monetary era is coming. That's absolutely clear in my mind. Of course, we will have ups and downs. We will have stock market bubbles. We will have crashes. But, one thing I've learned, that to forecast price is a mug's game, and it serves very little purpose.
Equities is even a bigger mug's game.
Yeah. And therefore, what I'm more interested is in risk and in direction of the economy and therefore of markets also. And to me, already from the end of the 90s, I decided that the risk is absolutely at a maximum already, and it's going to accelerate and get worse. And therefore, you needed protection. And protection, of course, my point of view was there's only one asset that has survived throughout history and maintained its value, and that's nature's money, which is gold. All other currencies, as we know, have gone to zero. It's so easy. If you want to protect your assets, your old nature's money, and you know that at least, as in the case for thousands of years, you maintain your purchasing power. You might not always make a lot of money, but now when we've entered an era where governments are accelerating the money printing because the deficits is also accelerating, and now it's such an easy decision. I think this is the easiest investment decision I've made in my life. So, we recommended up to 50% in gold 25 years ago. And now I would recommend 100%, or we recommend maybe 25, 30% in silver. It's obviously putting all your eggs in one basket. But, it's like Rockefeller said, put all your eggs in one basket and look after the basket. and
I can't remember the name of the old Italian family, but there was a story of how they retained their wealth going back centuries. When wars came, they left with their gold and their art. They had title to the lands, and when the wars ended, they came back and they retained their wealth.
Yes, I think we are in that era now. Of course, everybody isn't wealthy and has art. Or in Venezuela, let's say, 25 years ago, if they bought gold then, the dollar was about par with the Venezuelan bolivar. Now, of course, currency is destroyed, the country is destroyed. And if they bought just a little fraction of an ounce of gold in those days, they would have saved them later. And the same today. People don't need to buy kilos or tons of silver or gold. They can just buy a small ounce, because I see now, this is going to accelerate. Currencies have gone down by 99% in real terms, in gold terms, since 71. It's just 1% to go. But that 1% is 100% from now. And that we are going to experience in the next few years, in my view. How fast it goes, it doesn't matter, really. Protection is more important than, as I said, forecasting the timing. You were talking about cycles of markets going up for a while and then going down. Yes, you're obviously into shorter cycles. In my world, we don't worry about that. We worry about protecting the risk that you have today. And there are so many black swans hanging above us. US banking system. for example. Civil unrest in America, we haven't talked about America, we talk about Europe. It's the same in America. I see civil unrest in a major way in America. It's already there. People are helping themselves, for example, taking or stealing any goods they want in shops. It's not just in America, happening in the UK also. Just walking in, hundreds of people walking into a shop, filling the bag, and they can steal up to whatever it is, $1,000. That's not a crime. And we are already into lawless society, and America will be very high on that scale of lawlessness, in my view.
Egon and Simon argue we are nearing the end of the monetary era, with the dollar, euro, and pound all in a race to the bottom. Forecasting gold in collapsing currencies is meaningless, only weight matters. The U.S. banking and financial system, built on endless debt and self-financed deficits, cannot survive, and capital controls are likely both in Europe and the U.S. Safe havens like Switzerland, Dubai may offer some protection, but risks are everywhere. The bigger picture is the clash between the old US-led unipolar order and the rising multipolar world. This transition could end in war, or in financial collapse triggering political and military breakdowns, likely around 2028. The only real safeguard, they stress, is holding physical gold and silver as protection rather than speculation. Now let's dive into the interview.
Trump is moving the reservists into Washington,
Yes.
Chicago, etc., etc.
You talk about capital controls in Europe. I see exactly the same in the US. From my point of view, it's a waste of time trying to forecast which currency reaches the bottom first. There's no...
It's a race to the bottom.
Yeah, exactly. And there's no prize for being the first. They'll all be there, the dollar, the euro, the pound, etc. As we said, they're already 99% on the way. So it's not far to go. But that will happen too. And that will be the end of this monetary era, the way that I look at the world. And that's why protection
I'm
is
in
more...
complete agreement. Technical Associate has the dollar index, the DXY, halving by the end of 2028.
Yeah.
DXY is now about 97. We have it at 50 in 2028. What does that mean to the gold price?
Yes, and you get to the point, Simon, and I've been saying that for quite a while, that, it serves no purpose to measure the gold price in collapsing currencies because it's meaningless. You might as well measure it in chickens or cows or something more useful. I mean, gold and silver should only be measured by weight, really. How many kilos or how many ounces do you own? That's the only thing that counts. You know that you will maintain purchasing power. And if it will be $1 billion for an ounce of gold in a few years' time or $1 million or whatever, it's totally irrelevant because what's the value of the dollar at the time? And that's why, as I said, I gave up forecasting the gold price many years ago because it is a mug's game, and to forecast it in something that is sinking by the day serves no purpose. I mean, I see the US banking system, it's not going to survive in its present form, and nor is the European one, of course. So keeping money in the bank, I wouldn't recommend anyone to hold any money except for short-term spending money. If you have gold or silver, it's total liquidity. You can sell a gram an ounce whenever you want, and there's always a price for it. There's always a price. Yes, you talk about capital controls in Europe, but when I see clearly that the same is going to happen in the US.
I agree completely.
So where do people go? That's what they ask, of course. They don't want to be in the EU. I mean, Switzerland always has been a better and a stronger economy than the rest of Europe. Of course, Switzerland is under pressure from the EU. Come into the EU net, comply with more of the laws and the rules of Switzerland, is withstanding it. And of course, as Switzerland sees the EU collapsing, I sincerely hope and I believe that the Switzerland will definitely stay outside of the EU network. Whether Switzerland will be a bastion of safety and economic insurance in the future. I think it will because it's a sounder people and sounder economy than most countries. But otherwise, go to Dubai, as you have done. And of course, it works very well for a lot of people right now. Uruguay is another country. Again, you're in the middle of a poor South America. You have Brazil and Argentina next to you. And when the bad times hit there, I mean, they are going to go to the rich countries like Uruguay.
Sure, yeah.
So that's a risk too. So you have a risk today that unprecedented. Of course, maybe the safest is to go to Russia or to China. But for Westerners, that doesn't feel right. US debt's never going to be repaid. And when you have a financial system with the dollar as the reserve currency being in a country which is issuing massive amounts of federal debt on a daily basis, and there's there's no buyer of it except for the central bank itself. You know you're at the end. You know that if you both issue the debt and you buy your own debt, that is
then
the
you're finished. Yeah.
ultimate of it. Oh, well, Ponzi schemes, isn't it?
Yeah. There's the question how all of this is going to end. Come back to where I started, that the real big picture is between the existing unilateral world that has operated for 80 odd years and the evolving multilateral world. It can only end in one of two ways. Either that the unilateral world, i.e. America, accepts that we are evolving into a multilateral world and therefore joins it. That's, under current conditions, is highly unlikely. Only other option is it's going to be war.
Isn't there a third option? America doesn't have to accept the dollar-based system and the reserve currency. It collapses. The financial system in the US collapses. The banking system collapses. Whatever desperate action they take with the whole Trump family now going into Bitcoin or cryptocurrencies and believe that that's going to be the savior of everything. That's not going to happen. In my view, cryptocurrencies are a bubble too, highly leveraged. And therefore, isn't there that third risk? I think that's a major risk that it's actually led by the financial system collapsing in the West, probably in the US first, but it could be France or the UK starting. It doesn't matter why the trigger comes. Isn't that a very high risk to this system also?
Yes, it is. But the multilateral world and the unilateral world is not just a financial one, it's a political one too. And that's why I think there are only the two big options. Now, you actually given the trigger as to how this war between the two types of world will end by saying, rightly so, that the US and the Western system, financial system, is going to collapse. And in that collapse, you will then have political collapse.
And military collapse.
Everything collapse. And on my cycle timing, that is around 2028. That's only, where are we now, 3 years away.
That's like tomorrow. It's so intellectually so exciting to be in this era now because, to discuss these matters and to try to not forecast exactly, but at least protect yourself and help investors around the world to protect themselves. And obviously with that comes helping family and friends and all of that. I see that as a major task of ours and for people who are privileged that we are, because whether it's 25 or 28 or 29, it doesn't really matter. The risk is here and now.
If the U.S. imposes capital controls, what options will remain for investors seeking to protect their assets? Could gold and silver alone provide enough protection in a scenario of systemic collapse, or should investors also diversify into other real assets? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.